Hey, what's going on, cash flow hackers? It's Chris with Life 180. This video, you can see behind me, I got my buddy Dave Ramsey on the monitor, and I had a text message from one of the agents that works on my team, reached out, sent me a message with a link to this video. The title of this video is Cash Out My Whole Life Policy, ? And the comment that I got from the agent was, Chris, this is possibly the worst Dave Ramsey video that I've ever seen. You need to eviscerate this thing. So, in this video, I'm gonna watch this video. I'm gonna bring you along with me. I'm gonna give you my opinion on whether I think this is the worst Dave Ramsey video I've ever seen or not. And I'm gonna interject my opinion and pause it and give you my reaction as we go. So without further ado, let's get into this. I'm gonna just put my headphones on and let's roll. So here we go.
Sue is in Chicago. Hi, Sue. How are you?
I'm doing great. Thank you for taking my call.
Sure. What's up?
My husband is 62 and I'm 58. We've been married 38 years. We have no debt and our net worth is a little over $1 million. 200,000 of that is in real estate, 800,000 in stocks and bonds. In 1997, we were raising 4 little boys and my husband went through leukemia and a bone marrow transplant. Ooh. And so the only life insurance we could get was a whole life, and it was a $600,000 policy. Dave and Rachel, we put in, since 1997, $10,000 a year into this policy. Now, fast forward, 15 years ago, my husband had a heart attack and 5 bypasses. Longevity in his family, the men, just historically do not live long lives. So here is our caveat right now. All the boys are through college, married, we have 10 grandchildren. And this life insurance policy, the cash value is now around $240,000. My husband and I are trying to make this decision. He is still working. He has an income of about $80,000 a year. He hopes to retire at about 65. My income a year after COVID, I'm a Christian motivational speaker, so my income dropped from about $50,000 a year to now $20,000. We are trying to make the decision of whether we cash in this whole life policy and put into our stocks and bonds portfolio, given the fact of his life expectancy to be.
What's the face value?
$240,000.
No, that's the cash value. What's the death benefit?
It's $666,000 right now.
Okay. Wow. Okay. So basically, if he dies, or no, when he dies, we all die.
So before I get into anything else, this is what I want to say. Like, with a couple of things going in, she's got 800,000 stocks and bonds, 200,000 in real estate. They were paying $10,000 a year into a whole life policy. It's got a $666,000 death benefit with $240,000 of cash value. I don't even have to watch this to know that in the next minute or so, maybe less, Dave Ramsey's going to try to tell her, well, you don't really have $666,000, you got $240,000 of cash value. The life insurance company is going to keep that money, and that ultimately your death benefit is a $666 minus the $240. The fact she's been paying $10K a year and only has $240,000 into this long tells me that unfortunately there's a couple things going on. I don't know if they're going to get into this in this video or not, but there's a couple things going on here. My guess is this life insurance policy is not with a major mutual company earning high dividends with a participating mutual company. It's not earning really solid dividends, and therefore it's not getting that great return. And it is also not structured properly. The fact of the matter is, like, if she's been putting that kind of cash into a policy for a 20-year plus period, she should have a lot more than $240,000 of cash value. And that would even be in a what I would consider an improperly designed policy. She would have more cash value than that. And so the fact that those numbers don't line up tells me that my guess is this is one of those policies that Dave Ramsey loves to hate, and that honestly, I would probably at the beginning of this thing be on his side, because there's no paid up additions. The fact is she bought it with a $660,000 death benefit. It's got a $666,000 death benefit today. As the cash value's gone up, the death benefit hasn't gone up. And so it hasn't really, I would say this is not a way I would ever suggest anybody design a whole life policy. Sadly, it happens too much. This is the way Dave Ramsey loves to hate him. And so I am interested to see his response at this point in time. So let's just get into it.
Yeah,
When he
I
dies,
understand.
if the policy is in place, you will receive 666.
Yes, sir.
Okay, that means they're going to keep 240. So you really have a $400,000 insurance policy.
Correct.
That's really what.
Yeah, I knew that was coming. So here's the thing to understand though with this is that it's not as bad as Dave Ramsey tries to make you think. Here's the deal. Yeah, the life insurance company is going to quote unquote keep that 240, but it's all actuarially done, right? Like this is why I always use paid up additions to increase the death benefit as we go, because the bottom line is that 660,000 minus the 240, the insurance company is going to keep the 240, but they're doing that because it's all baked into the actuarial equation of the cost of the insurance and so on and so forth. And so the thing is that, yeah, you could look at it like we have a $420,000 life insurance policy, and the rest of it is a $240,000 savings account, because even in a poorly designed policy, when it's this mature with a company that doesn't pay great dividends, that $240,000 is still a great, safe, liquid, accessible place to keep capital. You could borrow against it. You could do a lot of things with it. So once again, curious to see how he goes into this and kind of where he goes with this.
Okay. And so the swing is, do you need the extra 400 to live? And the answer is no.
Mm-hmm.
You don't. So if you cash it out and put 250 in there, or if you keep it, either one, you're going to be okay either way, financially speaking.
All right. So once again, this is just, okay, such a scarcity mindset. Do you need, could you survive without? This is such a scarcity mindset and scarcity words that are coming out of his mouth. It's all fear driven. There's a reason the wealthiest people in the world own the most life insurance. It's because they understand it's not about what they need, it's about what they want. And the fact that they have real estate, I don't know what their situation is, outside of their kids with this one kid that they were talking about. I don't know that situation, but $200,000 in real estate, $800,000 in stocks and bonds. If they don't need that money to live, the money that's in the 240, even if they did, they could borrow against it. They could utilize this $240,000 as a volatility buffer, because my guess is this $800,000, and I'm looking at my notes here, this $800,000 in stocks that they have, they need to pull income from that, right? So as you look at this $800,000 in stocks and bonds that they have, they need to pull income out of that. Now, she didn't give the ratio breakdown yet. Maybe she'll do that later. I don't know. But out of that $800,000, they need to pull income from that. So if you look at the 4% rule, $800,000 is not going to get you a lot, right? Like my guess is maybe they have low debt, whatever, but you're looking at $32,000 a year using the 4% rule from that $800,000 that you could pull out safely without really running a risk of liquidating that account or running out of money during your retirement years, right? And so I don't understand what the real estate net worth is, if that's home equity, if it's a rental property that they have, if it's kicking out cash flow. Once again, they haven't gotten into that yet. Dave hasn't even asked those questions yet to really figure out what is the right thing to do. He's already given his opinion, and so that's a problem. But the bottom line is $32,000 a year out of the $800,000. If they start keeping to try to pull that $32,000 a year, maybe that's enough for them. If they try to pull that $32,000 a year out in retirement and the market has a negative 20% year, all of a sudden now that account is losing $160,000, plus they're pulling their $32,000 out. Before you know it, in 1 year's time, that $800,000 is worth $600,000. Their need to pull that $32,000 a year out for income doesn't change, and that's where the risks really start compounding, right? And so one of the powerful things that he doesn't realize from a real planning perspective is that $240,000 that they have in the whole life policy is guaranteed. It's liquid, accessible. They control it. They could borrow against it, even in a poorly designed policy. Once again, I don't know the company they're using. I can't speak to that, but they could borrow against it and utilize that as what's called a volatility buffer, and so when in down years, the worst thing you can do is liquidate a negatively performing asset, right? So in down years, when the stock market tanks, if it goes down 20% and they still need to pull that 4% out, that $32,000 for income, rather than taking it from a negatively performing asset like they would normally, they could take it and borrow against the $240,000, or even surrender, do a withdrawal, because they can withdraw up to cost basis with no tax penalties, right? They could withdraw $32,000 and surrender a portion of the policy, and not have to tap into that $800,000. That way, it would allow that $800,000 to recover, and so that would allow them more flexibility and more stability when it comes to their retirement income. And so you can't just look at this. So look at it just with the questions that he's asking and how he's already giving advice. It's kind of laughable. So let's get into this.
Mathematically speaking, agreed?
Agreed.
Okay. So this really comes down to a bet that you're making, not based on the past, but for $400,000, I'm going to bet that I'm going to put in less than $400,000 before he dies. Right? Mathematically,
Okay.
it's very cold-hearted, but it's a math thing.
Okay.
And so it's...
Once again, it doesn't matter. That's not true. Like, there's so many more options than just surrendering this policy and taking the 240 and putting it into stocks and bonds. They could do a reduce paid up on this policy. They could just make it so they don't have to pay anything from here forward and lock in guaranteed death benefit above and beyond their cash value, have their cash value continue to grow on a guaranteed basis, and be able to utilize it for the volatility buffer strategy that I was talking before. I'm not saying they should keep paying the premium. Depends on their cash flow, depends on their objectives, depends on what their wants are, depends on what their needs are. But the bottom line is, this asset of $240,000 is infinitely more flexible and more powerful than any other safe vehicle that Dave is going to be able to suggest to them, including bonds right now. And I can't imagine what his thoughts are on this. So yeah, let's keep going.
And what's the...
Like, can she save another $400?
Still at... No, I'm saying she's paying for a $400,000 life insurance policy, in essence. They are paying. Okay? And if he dies before you put $400 into it, if you put $300 into it, you gained by $100. Right? And that's the math. Good. And is it currently, and it will be forever, $10,000?
So frustrating.
Yes, and that's been our first. Since we got it, we fund that first, and then our employee matching, and then our Roths. That's been our...
Yeah. Well, that would not be my order of priority. But if we're just making bets at $10,000 into $400,000, that's 40 years, is it not?
Yes, it is.
So if you're just placing bets on the math, you're going to keep it.
Okay.
It's a crappy product. I probably would have dropped it 15 years ago or 10 years ago and saved that money and quit then. And I hate it. I think it's a horrible product. But at this stage, what it's come down to is, if you're going to get 666 upon his death, which is a weird number, by the way, but
yeah, it is. It is.
But if you're going to get that upon his death, then and they're going to keep 240 of yours, that's 426 difference. Then he's got to live 42 years before you don't come out ahead. If I'm doing my math right, am I doing something wrong? 400 divided by 10 is 40, isn't it?
Yes.
Yeah.
Yes.
And so 420 divided by 10 is 42 years. He's 62, so he's got to make it to 104. Probably not happening. I mean, I'm probably not making it to 104, and I got longevity in my family, so, you know.
Right.
But
and she comes out better ahead doing that
Now
versus
that,
cashing it all out, taking that 250 and putting it in an investment.
Yeah, I mean, that's a very simplistic way of doing it, okay? If we want to get one more level of sophistication, we could say the present value of that money.
Right.
In other words, were you to invest $10,000 a year, how long before, at an 11% rate of return in your stocks and bonds, what the market has returned, how long before...
Okay, so first of all, they're going into retirement right now, okay? So going into retirement, the fact that he's telling them that going into retirement, they can take their money and invest it and take the kind of risk that you're going to get 11% in mutual funds, which, by the way, is never going to happen from a long-term perspective. He uses that number all the time. It's just, to me, if an advisor used that number that was licensed, they would get in trouble. They would get sued. They would lose their license. And he just gets away with throwing these numbers around with nobody holding him accountable. regardless. Let's say it could happen during your accumulation years, during the time that you're 20s, 30s, 40s, 50s, you're accumulating money, you're being productive, you're working, you're earning an income, you're saving a portion of that money. Okay, let's say you could earn 11%. That's great. When you hit retirement, your need to mitigate that risk goes up a lot. And so you cannot take the kind of risk that warrants getting an 11% return. You just can't do it because of what we talked about with the sequence of return risk. And this is why, once again, the power of that $240,000 sitting there for a volatility buffer. Now, once again, he's only talking about these options like they can keep paying it. They have to keep paying it. Maybe they want to do a surrender of a portion of the policy, do a reduce paid up. So you reduce the death benefit and the cash value is completely paid up, right? So the policy is fully paid up at that point in time. You never have to make another premium payment. You never have to do another thing. From that point forward, the cash value continues to grow on a guaranteed basis, and they'd be able to leverage this in a lot of different ways. For a guy who says he hates a product so much, he obviously is either manipulating people or doesn't understand enough about this product to actually advise and coach people to what their options are around it. Because just the fact that he's going here and making the statements that he does without knowing what he's talking about or without bringing these points up is a huge red flag to me.
Where you'd get to 400,000, I don't have that off the top of my head, but it's probably still 20 years.
Right. So if I'm tracking with you right, because this has been a dilemma for me. We're pretty financially savvy. We did Larry Burkett before. We heard of Dave Ramsey and have done the envelopes before they were cool. And I think about if I pull out, pull out the cash benefit of $240,000 approximately, and I invest that. Plus, I'm freed up $10,000 a year to
You're
also
right.
invest.
You're right. Your equation is more complete than mine. You're right. You're exactly right.
It kind of swings this pendulum the other way.
Well, you got to get to if you do that, you got to get to 666, but you'd get there in
with the 250.
You'd get there in 7 years, 6 years.
Exactly.
You know what? You got me. You got me. You didn't need me. I needed you. Okay.
Once again, they're missing the best option. I don't know enough about this product, right? Like, so I don't know. I haven't looked at this insurance policy. What are the terms of this policy? Okay, we know the terms as far as it's $10,000 premium. It's a $666,000 death benefit. There are obviously no paid up additions structured in, so it's a horribly designed policy, which is what it is. We can't control that at this point in time. So the question is, what company is it with? What are their options at this point in time? I don't know what company it's with, but what I do know is that most companies have what's called living benefits with it. And by just cashing the policy in, a lot of the death benefit that they have, it's not just death benefit. They could utilize it if they become critically, chronically, or terminally ill while they're alive, to be able to utilize it for alternative medical treatments, to be able to utilize it for long-term care, to be able to utilize it for a lot of these things. He didn't even ask them, what are their long-term care plans? 70% chance they're going to need long-term care at some point in time in retirement. He doesn't even go there. The fact that he's just throwing this information out and kind of advising people to cash these policies in and just looking at it from like a spreadsheet perspective of investments versus safe money, and you can't compare the two. The two offer completely different values, different benefits. I'm not saying that the risk in the investments and the bonds and all that stuff, that portfolio isn't important. I think they should have it. Once again, we didn't even get into, he still hasn't asked what the real estate situation is. Is that creating cash flow? Is it just equity in their home? Is their home paid off? Like all that stuff. None of that is covered here. He just goes straight for the jugular just because he's so, I don't know why, but emotionally triggered, like whole life is the devil. And, to me, nothing could be further from the truth. In this video, I don't know if this is the worst video I've seen, but this video certainly shines light on the fact that he's got some weird emotional trigger that's not justified in any way, shape, or form with logic. And that when you look at this from a mathematical perspective and from a real holistic planning perspective, when you took at the take a look at the living benefits, the tax advantage benefits of how this passes on to the heirs, because I don't know about you, but for me, a biblical notion is we got to leave our kids with more than we came into this world, right? That goes from money, from knowledge, from skills. It's our job to build up the next generation. By having this policy, you're locking in place a fact that you're going to leave the kids with a better setup, and you can leverage it in a lot of different ways. You have the living benefits, you have that death benefit, the tax-free nature. As soon as you cash that money out and put it in another vehicle, the taxable nature of that when it passes on to the next generation is not going to compete with where it is right now. The fact that you're putting that money into risk, the fact that he's in, and there's now, he doesn't ask them, what other money do you have for an emergency fund? What's your other safe money look like? Because they didn't talk about any of that. This is a great alternative to a savings emergency fund and an opportunity fund, right? So he didn't even ask that. It just, I don't understand how people listen to this man and take his advice as gospel. He preaches biblical principles. He also goes at people with fear. He comes at things with half-baked information. And is just very emotionally triggered. You just watch his body language and his condescension and his tones and everything that he does. It's just super frustrating to me. So, all right, let's try to endure and get through the rest of this and see what happens.
Oh, yeah, you're exactly right. You're exactly right. I left a variable out of that. Oh, wow, that was dumb. Okay, you got it. You're exactly right. Good. No, you're exactly right. So what I would do is run the sit down with your investment advisor and run the calculation. If you invest at your current rates of return on your investments, $250 plus $10,000, and how quick do you get to 666? That's the equation. And if it's at 11%, I think you're there in about 5 or 6 years is what I think it's going to come out. I'm doing that in my head, but I'm not far off.
All right, so he's going there. How about you think about the sequence of return risks and the fact that in retirement, you figure out what your needs are. Retirement income planning and locking that into place. You know, Tom Hegna wrote a great book, Paychecks and Playchecks. Leveraging this money to fill and lock in guarantees for retirement income, I mean, is a huge benefit. And to me, this is an asset that he's suggesting that they liquidate, thinking about it through one perspective and not seeing all the different angles. And on top of that, he's missing some of the most obvious options in which they could handle this policy without continuing to fund it. So they could keep this and they could keep the $10,000 cash flow and continue to fund an outside investment if that's what they wanted to do. They wouldn't even need to cash this in. So, you know, I don't understand. This video is ending already. You can see the end screen there, but you know what? I wish, you know, people wouldn't take his word as gospel when it comes to this stuff. But if you have any questions, any comments about this, about my takes, if you have any questions, if you're going through, if you've watched his videos and you're considering like, what are your options around your policies that you've had for a long time? My guess is if you have a 20-plus-year-old policy with any major mutual company, there's a lot of options that you have that can enhance your financial life in a lot of ways, even if it was not, even if it was the policy design that Dave loves to hate for the first 20 years. If you have it now, it could be really powerful. And if you have questions about that, you can reach out. I can have somebody on the team help you. There's a link down in the description below. Happy to help in any way possible. So that's it. If you haven't already, please like this video, share this video out. Make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. And as always, have a blessed and inspirational day. We'll talk soon. See ya.